Good morning, everybody. Welcome to today's 1Mby1M Strategy Roundtable for Entrepreneurs. 1Mby1M, as we know, is the first and only global virtual accelerator for technology startups in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. In support of our mission, we do these free mentoring roundtables week after week after week, month after month, year after year. This is the 513th session. We started way back when in 2008 actually, right before the financial crisis. And we have pretty much shown up every week, minus, in a 52-week year, we're probably doing roundtables at least 45 to 47 weeks with a little bit of gaps here and there, breaks here and there. So this is the last one for this year. We have taken very few breaks this year, and it's been interesting to see how entrepreneurs are holding steady and holding their nerves steady through this crisis around the world. And we do see people from all over the world, and through various ups and downs that are happening all over the world. Right now, we are actually, again, an epicenter. California, I'm in Silicon Valley, California. California seems to be moving in the wrong direction, and most of America is anticipating a very, very difficult winter. So stay safe is the big message. The event is being recorded. All roundtable recordings are available at our YouTube channel, 1M1M Roundtables. On Twitter, we're at 1M1M and at Stromana. Hashtag 1M1M is today's hashtag for live tweeting. I will put the slide back up later. This is a roundtable, not a broadcast. We want you to participate, and you are very welcome to call in and talk about whatever it is that you would like to discuss. I'll put this up a bit later. We have scheduled programming first. We are going to start today's session with a conversation with Sasha Mirchandani, founder and managing director of Kae Capital. Sasha has been here before. I have known Sasha for a very long time, and I'm really looking forward to catching up with you, Sasha. Welcome back to the show.
Look forward as well.
So, Sasha, why don't we start with kind of an overview of the Indian startup ecosystem and the trends that you have observed. You've been at this for a long time. What has happened, and we can dialogue a bit to understand where we are in the evolution of the Indian startup trend and Indian startup movement, let's say.
Well, Shramana, Indian startup ecosystem has been going for quite a while. If I remember correctly, it started very early in the early 2000s, around the time of the dot-com era. A few VC firms showed up, put their flags down, but most of them disappeared post the dot-com era. The second bucket started in 2006. This is when the serious bucket started. It's approximately 2006 when VC firms started coming back into India. We had several different firms that wanted to come. There was one, the global suitcase VC. So they would show up from Silicon Valley with a suitcase and look for deals and go back to the valley. There was second was firms that set up shop in India with having one person in India, and they had management committees, etc., partners, mostly in the US or China and other markets. You had a third bucket, which was actually Indian firms like Nexus, Helion, etc., that started off actually putting between 2006 and 2008, starting up in India. And around the same time, you started having global firms like Axel, Sequoia, actually having Indian outposts with Indian management, Indian partners, actually partnering with these firms like Matrix, Lightspeed, Sequoia, etc. started around 2006 and 2008. And then post that, we've obviously had many more firms come into the ecosystem. But that was the first time when large firms came into India and started investing from Indian capital that they had raised. Today, it's evolved quite a bit. It's a very large industry. You have pretty much every top-tier US VC now in India. You have a bunch of Indian homegrown funds that have scaled up. Each of them are managing well over $1 billion comfortably each. We have a bunch of seed funds like us, Bloom, IQ, etc. that have come up. and there's a whole bunch of private equity as well on top. So it's pretty robust, the ecosystem, and still growing. It's quite exciting actually right now.
So in terms of, you've talked about the investor trends, let's talk about the sectors and the types of industries that have done well. By the way, folks, those of you who are listening, and if you are followers of the Indian ecosystem, one of the earliest Indian startups that has scaled and has gone public in the U.S., this IPO just happened. Pubmatic has gone public. It's kind of like a milestone event. We're going to see more. There's at least several others in the wings right now. Dhruva is going to go public most probably next year. Freshworks is going to go public relatively soon. There are others that are in the background. Of course, there's the whole e-commerce world that has done very well, the India market facing the Flipkarts and the Paytms and the related the online travel agencies and so forth. So how do you summarize the sector trends? How do you view the sector trends? What is your current investment thesis by way of sector trends, and what does COVID do to the Indian startups?
Yeah, so if I step back and look at, say, the early parts of the 2000s when we started Kae Capital, we were looking primarily at two categories. Of course, consumer tech.
Yes.
India is a large enough market to build large companies in the consumer tech space. So we were primarily focused on the consumer tech space, Amla. And we had a small piece for B2B, SaaS or B2B analytics, B2B cloud. Basically, companies that are born in India, Bangalore, Chennai, maybe Mumbai, mostly moving to San Francisco, maybe New York City. That was a bulk of our investment, 70-80% consumer tech companies, because India is a fast-growing consumer tech market, as you can imagine. So at that point, you could think of India as a hybrid between the Chinese and the Israeli market. Our B2B businesses had to go global to build scale, while our consumer tech companies like the Chinese market could build large enough companies like the Flipkarts and the Mintras of the world, etc. So that's what we did for the longest time. But then what we've done post that in our subsequent funds is expanded to very interesting categories like consumer brands. We're now seeing that you can get venture scale returns in consumer brand businesses, and we actually have some very interesting companies in our portfolio that have proved that out. We're also seeing the B2B enablement of SMEs, and that's a huge opportunity within India itself. And some of our best companies now are coming out of that category. So it's a very, very exciting space. For the longest time, we never looked at companies within the B2B space in India, but now that's really exploded. And we're pleased to report that we have some very exciting companies in that category. So if I were to summarize, consumer tech, that will continue to go. India is this very nascent market. Consumer brands, SaaS is now becoming a very strong focus for us. We've done far more SaaS companies in our second fund than the first fund, so that experiment worked out nicely. And then, of course, the B2B India story is now the Bharat story, the India story is actually very exciting as well.
Let's unpack each of those a little bit. So let's talk about B2C tech, India-facing. The beginning of it was focused on a kind of like, even though we talked about a 1.3 billion population and a much larger market opportunity, the real internet consumer, the spend was in a relatively smaller segment of spenders. It was the high-income group, the educated group, the very online savvy group. And then along the way entered Reliance with Jio and kind of democratized access in a very big way. Have you started seeing a meaningful expansion of the Indian consumer base?
Yes, we have. And in fact, to your question about post-COVID as well, we're seeing a very dramatic improvement in sales in the smaller markets. So we have several consumer internet companies whose sales are quite dramatically improved in the smaller markets. There's still markets which may not pay as much as a metro would, but we're seeing tremendous appetite in these markets. So it's a very exciting period. In the next couple of years, we see tremendous growth from these markets because a lot of these folks are going digital first from day one. They don't need to have stores, etc., because the infrastructure to put up all that stuff in India is very difficult. It's very expensive. It's tedious. but the experience online is so efficient that the customer is ready to go digital from day one. So we're seeing huge opportunity for these companies to scale in these markets. It's a pretty exciting time, and it's a good way to expand the market overall, obviously.
So if you double-click down into consumer tech, there are 3, maybe 4 segments that ought to be looked at. One, of course, is e-commerce, which is the leader in consumer tech. The second is online education. The third is fintech, and the fourth is healthcare. Could you comment on each of those and what you're seeing and what are the trends in each of those?
Actually, we have companies across all 4. So we are equally excited. It eventually comes down to the entrepreneurs that we pick in these categories, because the market opportunities in all 4 of these are actually, as you can imagine, very early days in India for any of these 4 categories. You've seen some amazing stories in EdTech. The companies like Byju is now worth more than 10 billion, which is incredible, right? It's unthinkable. Or, Unacademy, 2 billion. If you look at fintech, you've seen some great success stories. Several unicorns are now coming out of fintech in India. One just came out just in the middle of COVID. Razorpay, right? Very, very exciting story as an example. If you look at some of the other 2 categories you mentioned as well, like I said, if you look at, let's say, consumer tech, we have a company called 1Mby1M. It's an online pharmacy business, scaling tremendously fast. Because at the end of the day, once COVID hit, no one wanted to go to the pharmacy, no one was allowed to go. But, you go online, it's a super experience. Anything that can be delivered to your doorstep in a safe, efficient manner.
That's an e-commerce story though, right?
Sorry?
That's more an e-commerce story.
That's an e-commerce story. But the rest was, of course, I give examples of fintech or, of course, like Razorpay and, companies like that doing extremely well, just exponentially scaling in the last couple of years.
And is telehealth scaling?
Telehealth scaling exponentially. There's some very exciting companies. We have a company called Cure.ai. It's not a telehealth company. It's an AI company for radiology scans. And now they do COVID scans. So it's doing business all over India, but now it's started doing business in the US. And it's got FDA clearance. Super exciting business. So not only are they taking care of opportunities in India, but global as well. For example, we have a company called Visa, it's a mental health chatbot based out of Bangalore, but a bulk of their opportunities in the North American market, because, unfortunately, post-COVID, we've all seen the value of, taking care of people's mental health. It's a major problem. It's a stigma, which is unfortunate. But Visa has done a phenomenal job of, helping people in duress. And we, as we go, we're actually becoming a U.S. business. We got primarily most of our business in Northern Europe, in U.S. markets, across Asia. So, we can see we're building global businesses sitting out of Bombay or Bangalore. And these entrepreneurs, Ramana, really understand the global mindset, which is quite encouraging, actually. Even though they're going to move to Boston, they could have run it from Bangalore if they wanted to.
Yeah, well, Freshworks has been mostly run out of Chennai. Yeah,
Girish just moved apparently last year or whatever, but all these years he's run out of Chennai. Incredible business.
So, speaking of B2B, you mentioned the rise of the Indian SMEs as a customer base, which took a little while. And one of the issues has been that it takes high touch selling and customer support to sell to these SMEs in India, and the unit economics become challenging. How is that changing? Are people willing to buy based on phone calls and online interactions now? And how is the technology adoption in the Indian B2B customer base changing?
It's changed dramatically. There's several companies, not one, that have scaled up across different verticals in the SME space, B2B SME space in India. And some of these companies are worth hundreds of millions of dollars, if not billions, in the last 3 to 5 years. There's a lot of user behavior change, a lot of leadership change where decision makers in the SMEs are now second generation. They understand tech. They see the value of tech. Even in a Kirana store, when I go to my Kirana store next door to my house, the young man I speak to, he's speaking in perfect English, and he wants to evolve. He wants his store to become part of the ecosystem. So we're seeing people open to change, which is most important. And then you have the entrepreneurs who are ready to give that solution. It's a perfect storm.
Yeah. Let's talk about your fund. It's been a while, so give us a little update on where you are, what fund, how what is the fund size, what's focus, what are the highlights of the portfolio?
So we're a classic, very early stage seed and venture capital fund. We invest the first, let's say, $700K to $1 million, take a board seat, and then we can invest a couple more million Series A and B. So maybe at best $4 to $5 million in one company. We never start with more than $1 million, maybe $1.5 million at best. We manage a little less than $100 million over the course of all our funds as we speak. And we generally partner with bigger firms like Sequoia or whoever we work with for their Series A and B and C and D. So that's how we work.
And what are the highlights of your portfolio currently? Or if you have exited some, you can talk about those as well.
Well, before I co-founded Kae Capital, we've done several investments which were very successful, like Mintra, which was a great success for us. We did a company called 1Mby1M, where I'm still a shareholder. I was the first investor in a company called Fractal Analytics, which recently closed with $200 million Apex partners. Within Kae Capital, we have several exciting companies like Porter, which has been funded by Sequoia, Espada, etc. We have HealthCart, which has been funded again by Sequoia, Sofina. We have this company I just mentioned called 1MG, one of India's fastest growing online pharmacy businesses. We did a company called Zetwork 2 years back, which is then being financed. It's a B2B marketplace for manufacturing companies, funded by Lightspeed, Green Oak, Sequoia, Accent, etc. So we've been lucky to have many very exciting companies over the last 10, 20 years since I've been investing.
Could you double click down on one each in the two categories that we discussed at length? One, consumer tech, but where the consumer base is expanding beyond the early affluent urban customer base?
You mean in one category where it's growing? In
one company, if you have a company in your portfolio that is experiencing that expansion of the consumer base, that maybe the geographically, maybe the tier 2, tier 3 consumer, city consumer base. 1MG.
Yes,
can you talk a bit more about what are they doing? What is the go-to-market strategy? How are they handling the unit economics, etc.?
So it's not rocket science. It's an online pharmacy business, Samla. And online pharmacy, as you can imagine, is a massive, massive market. So for us, massive markets is critical. And this is a great example of just a humongous market, completely fragmented. It's probably one of the fastest growing categories in India as we speak. And what's happened is post-COVID, like I said, people who anyway were using the product, using the service quite extensively. But now, once we got locked up, people started using it substantially faster. It's grown. I can't reveal the numbers, unfortunately. We're in the middle of a fundraise. But the numbers just have exponentially exploded in the last 6 to 9 months. And now we can see this becoming a multi-billion-dollar business in the next 5 years.
And what is the customer acquisition strategy? Is it Google AdWords? What makes this unit economics work? I would imagine the tier 2, tier 3 city consumers, that traffic is still relatively inexpensive, right?
Yeah, I mean, Google, Facebook, the usual suspects, right? Each of our companies works differently. And, whether one works with 1MG, we call it picking a lane. You've got to pick one lane. A lot of companies try too many things, Samna. What we've seen work where the company, I'm not talking about 1MG per se, because I don't want to talk about what they do specifically.
Yeah.
But what I've seen where it works really well is if a company picks one lane, once they get going and experiment, because a lot of times, you need a lot of money to expand your marketing and online channels, etc. So what I advise people is to pick one lane and then go deep into that lane. And those are the companies that actually end up winning.
And do you have an example of a company that is catering to Indian SMBs in your portfolio, a B2B tech company?
Yeah, like I mentioned, Porter, Zetwork. Porter is, intercity logistics company like an Uber for SMEs, like these small little trucks. They go from, company to company delivering goods during the day. It's a huge opportunity. We just closed a large round with Espada, Sequoia in that company post-COVID. And I can see this business eventually becoming a public company. It's just incredibly early days. Huge, exciting opportunity. Because we're just in 6 cities right now. We can be in every city in India in the next 5 years.
Mm-hmm. Very cool. Is there anything else that you want to highlight from your experience or portfolio before we move to the entrepreneur pitches?
Well, no, I think what we've learned over the years, Samna, is that, large markets are critical. A lot of times, we go after really good entrepreneurs, which is obviously obvious. But the reality is going after a very large market helps the cause tremendously. So I encourage entrepreneurs to really think through the markets they're going after. When you hit the right market, the opportunity to become a very big company is so much easier than trying. Like I had companies which we funded in 2001. They eventually got to the market in 2010. And most funds don't have that time, right? It's 10 years to get to scale and get out.
Right.
And for example, my analytics company, we started in 2001. Today it's a huge company, but because I held it privately, we could take our time to build it to get to scale. But otherwise, it's very important to time the market.
Well, timing makes a huge difference, obviously. Personally, I actually think that markets, the size of markets, the timing of markets are bigger drivers in entrepreneurial success than people.
That's what
mediocre people in hot markets with the right timing can make great companies happen, but great people in mediocre markets.
Well, mediocre people can never make it happen, but a solid entrepreneur can make it happen. Versus a very good entrepreneur in a very small market, obviously for him or her, it's that much more difficult.
Yeah. I think if you're trying to build a venture scale company, I think you need large markets. That's basically the bottom line, absolutely. And I think timing is a really important thing. That's one of the things that we talk about a lot in our program because we work with very early stage entrepreneurs. You kind of have to have runway, especially if you're trying to do something contrarian, something different, that the market is not yet ready for. You're betting on timing, essentially. When would the timing hit? Like you're talking about online pharmacies in India. Well, COVID has accelerated that. There's a lot of companies that have benefited from COVID because of this extensive online push that has happened in the last 6 to 9 months. So, but they, in many cases, those markets were growing much more slowly. Online pharmacy was not growing as fast before COVID in India.
We are paid, Samna, to figure out the weak signals. There are weak signals as we speak for opportunities. So we were paid to see the weak signals in online pharmacy before other folks. And obviously we missed many other categories where someone else read the weak signals. Because it's like mobile, right? Before mobile exploded, the folks who invest in such companies, like say Oyo Rooms for India, those are the firms that benefited tremendously. So the weak signals is critical for us to assess. And say, okay, we're seeing something here that's a weak signal, that's going to become a full-on signal in a couple of years, let's jump in now. Yeah.
Well, and it's not easy to gauge how long it would take for a weak signal to become a strong signal. So you make bets and then externalities that drive the signal becoming strong. Very good. Well, Sasha, great catching up with you and hearing more about what's going on, and we'll keep in touch and have you back again. Bye-bye.
Thank you very much, everyone, and best of luck. Stay safe. Happy Christmas New Year to everyone. Thank you, Shramna. I'll check out.
Bye-bye.
Nice to meet you, Sasha.
Yeah, nice to meet you too. Best of luck.
All right, folks, we are going to go to the entrepreneur pitch session next. As you know, this is a safe working session. We're going to brainstorm about strategy. So we are going to, we're completely on your side. There is absolutely no agenda other than, helping you move forward. If you disagree with my feedback, that's fine. It's your venture. You're going to do what you want to do eventually. Just listen to the feedback and see what you want to do with that feedback. Remember, though, not all businesses can raise money. One of the big factors of raising money is this very large market opportunity, venture money I'm talking about. and that requires also a fast growth, accelerated opportunity. So this thing we just discussed about weak signal versus strong signal, if you are way ahead of a market that hasn't yet started gaining ground, it's not easy to convince investors to place those bets against weak signals. Anyway, let us get going. Joe Ko from Orange County, California. And Joe, please unmute your line and get going.
Hey, Shomna, nice to meet you, and nice to meet you, Rajesh. And yeah, so I'll just get going. Can we move on to the next slide? And the slide after that. So I'm the founder of Predicate Group, and the problem that we're essentially tackling is it's actually a very trendy problem right now. But for me, it wasn't trendy. Just quick background: I'm a legacy Amazon 100 seller. I've been in e-commerce for more than a decade. I've sold everything in every category on every single platform. Yeah, and I've grown multiple brands, and I've grown omni-channel brands. So the problem that we're essentially tackling is when you're starting off as an entrepreneur, right now in the U.S. market for e-commerce, it's really easy to have access to start selling. But what happens is you hit a roadblock after you hit about 1 million plus. And we know this because if you look at Amazon's data, you know that there's 3 million Amazon sellers, but there's only 30,000 of them that make more than 1 million a year. So that's a huge gap difference. And we're talking about a $200 billion market a year. And if you expand that into just e-commerce, because it's not just Amazon. So Amazon is actually a foreshadow of what happens for most people when they launch on Shopify or anything like that. So this problem is essentially it's everywhere. And so right now the trend solution is that there are these private equity 2.0s. What they do is they buy out these Amazon seller companies and then they roll it up. There's about 1.5 billion this year that was spent on only about 10 companies essentially buying out these Amazon companies and rolling it up. And the reason why they do that is because they found that once you kind of do that, you can generate more. You're essentially not only just buying revenue, but you can make the marginal difference off consolidating the infrastructure. And that's exactly what the issue here is. And so next slide. And so when I built this business, this is a 3-year business now. I agree with the problem, but instead of acquisition, because acquisition is so expensive, and also you're essentially Frankensteining different like big organizations and kind of putting them together. My solution is incubation. What we do is we create a model in which we partner with overseas small to medium-sized manufacturers and distributors. There's a lot of them already, immigrant manufacturers in China who came over and they essentially make product and kind of sell to Walmart and Target and all of that. And they pretty much are already the big, like a big part of our existing supply chain. And given where the timing is right now of COVID, I would say like 3-4 years ago, they weren't interested in maybe going on e-commerce as much because just it would be a splash of revenue compared to how much they were selling in retail wholesale. So, but right now things are a little bit different. And I would say that if you're able to bridge that to leverage their resources, and then also on the front end, use it as a testing platform like Amazon and Marketplaces to acquire valuable sales data to essentially create affordable products cheaper, faster, then you essentially have a solution that is cheaper, faster, better than consolidation. So can you go to the next slide? So what I'm trying to build is we call it a digital Procter & Gamble. So imagine Procter & Gamble, except that we're not trapped by Walmart or Target or any of that. We would just go straight from creating a brand. We would take the data that we learned. We would incubate a brand straight from the manufacturer and then sell it directly onto to the customer on D2C channels, on all of e-commerce. And we would try to do this globally. And so what we're trying to do is we're essentially trying to build a a modern consumer product company that's a tech-driven platform. And for just FYI, for the highlights, I bootstrapped this business. We've done 0 to 20 million GSV in 3 years. We've been growing we've been growing quite fast. And then, so what I've done is I've essentially proven out that this is a model. I just need the cash to scale. So can we go next?
Let me understand your business. How many brands are in this 20 million GSV that you have already created? How many brands are in that pool?
Can you go to slide 12? Or you can keep going. There's a little chart that has a bunch of these bubbles. Yes, this one. Oh, sorry. Can you go back? So this shows the traction of the brand year over year.
You have to talk through it. I can't read this and make sense of it.
Yeah. So these are about 10 different brands in different categories. When I first started, we did a partnership with a toy manufacturer. The Asian family, they immigrant toy manufacturer. They make 60% of Walmart's private label toys. They own the molds, but Walmart essentially just buys the products and then wrap it up into Walmart's, private label. But they had a ton of products. And so essentially what we did was, we again built out essentially a program in which we're strategically sourcing the right information based off marketplace data, and then we just start picking out products that's already there. And for them, it's almost no risk because they've already have these products laying around, right? And actually, a lot of these products they've been selling for many, many, many years. And so, is
that the Bully one, the first one?
Yes. So that's 0 to 10 million within a short span. And just so you know, for some facts, it takes an average Amazon seller multiple years to get to 1 million, and I've done it multiple times. Yeah.
Hang on.
Yep.
Hang on 1 second. What is your relationship with Boley? What is your business model?
Well, so Boley started off as my first beta, right? And that specific one started off as we take percentage of profit. And then as we started to grow, where we are right now is we essentially look at the market, we'll create a new brand, we own the business, and then they essentially come in as either a minority equity partner in exchange for their product, and essentially giving us their product to test, and then using their debt revolvers. But for us,
you have
essentially,
separate companies for each of these brands?
Yes. So that's what's happening right now is we get to. So the beauty of this whole thing is we get to pick which one we want to actually invest in and continue to grow as a brand, depending on the different product categories and the different product catalog that gets shotgunned. If you go to slide, I don't even remember. Let me see. On one of the slides, I show that what our model looks in comparison with your average Amazon seller. And then I also show another slide in which I'm comparing this model with the current consolidation model competitor that's getting a lot of trend right now.
Okay, so my first comment based on what you are talking about is that the financial structure of this is not conducive to raising funding. You're going to need to engineer this company in a way that is acceptable to investors, in my opinion. You may have any other opinion from various other people, but in my opinion, in the world that I live in, which is the world of technology investments, this is not structurally, this is not a model that they would want to finance. So you're going to have to work out the details of how to structure this from a financial engineering point of view to make this work. That's one of the issues that stare at me right off. There are a lot of things I need to understand to be able to advise you properly, but the first thing that stands out is there's a structural issue.
Well, so there's two things I would say to that. The first thing is that, again, we're doing our A round, so it's kind of part of the process of, we'll kind of continue to work on it. I've dabbled with different type of financial structuring. But in theory, let's say you didn't even need, it's no different than creating a new brand from scratch if you wanted to. If you had the capital in the bank, you could just take the data and form a new company and purchase the inventory, and your books would be just like
That's not what I'm talking about. The fact that these brands are separate companies with separate equity structures is not a model that venture funds can finance.
Oh, right. No, I understand. We don't have, again, like, we don't have different type of equity structure. I mean, they essentially would just finance Predicate, which is the holding company. And then these are just different cash streams going into there.
Yeah, but they're separate companies. That holding companies are not financed by VCs. That's not going to work. So you're going to need to restructure this company. If you want to raise venture money, there may be other kinds of money that you can raise to fund finance a holding company. But the world that I live in doesn't deal in the kind of structuring that you're talking about.
Can I learn a little bit more about what kind of model would work in this case? Because again, we're just presenting the idea here and the problem and the solution.
Yeah, I will help you. If you decide that you want to work with 1 million by 1 million, I will help you restructure this in something that is going to be palatable in the world that I would be bringing you into.
Okay.
So let me work with Rajesh, and we can come back to Q&A afterwards. And I'll explain how to use 1 million by 1 million. All right, Rajesh, you're up next from Madurai.
Yes. Hi, Shamana. Thank you for your time. So let me get started by presenting my presentation. This is going to be a little different presentation. It's not a company that is already existing. It's a concept that I'm going to present.
Okay.
To start with, we are trying to build a concept company that could solve the Indian consumers' need to have accessibility to global eyewear brands. So if you look at India as a market, undoubtedly it's a huge market, and there's potentially, a huge market or demand for everything. And if you look into how the eyewear market is expanding, it's at currently a 30% growth on a year-on-year basis, and today the eyewear market is at $10 billion. However, this market is potentially seeing an 80% unorganized segment. There is only 20% of this market is kind of regulated or organized sector. And we also see a significant increase in revenues for the players here. For instance, Lenskart and Titan Eye Plus is making more than 60 to 70 million dollars every year. The key constraint or the key problem here is for such a large market, we only have very few global brands. So if you look at the online retailers, they are just selling roughly around 12 brands and with very minimal designs for the consumers to choose.
You are aware that eyewear market is a highly concentrated market with most of the brands being owned by Luxottica, right?
Correct. It's I'm coming to that presentation also. I'll tell you the reason why even Luxottica, despite being owning a lot of the brands, are not even making the money that it was intended to make here. The big retailers in India.
Is your proposal to sell Luxottica brands, or are you trying to go outside of Luxottica?
Including Luxottica. And
okay.
It's Luxottica and beyond, yeah. So if you look at
you're going to have to honor Luxottica's prices in that case. I'm just trying to understand what is the thesis here. There are, on the internet, in the eyewear category, we've actually done other eyewear, contact lenses types of e-commerce businesses. We have lots of case studies. We have seen people kind of going outside of Luxottica, outside of the major manufacturers, and creating something that is affordable. That is not what you're trying to do. What you're trying to do is becoming a consolidator of different brands.
Correct.
Okay.
Okay. So if you see here, the reason why I'm telling this is because customers are now showing a high aspiration to own global eyewear brands. If you look at it, if you look at Luxottica, they are reporting a strong $17 million growth, revenue in 2018, and they're growing at 6%. And even in a COVID situation, they had a quick business recovery of 75%. And in their own words, they are assuring that for a luxury consumer, even in the COVID times, the average ticket size is not reduced. We even did our own survey on 56 users, and we found that, for an available global brands like Ray-Ban or Oakley in India, there is a high likelihood of, people prefer to buy 22%. Whereas if we took into the unavailable brands or the aspirational brands, people still wanted to buy them at 17%. It's the average respondent.
I agree with you that there is a luxury consumer in India that is interested in buying this brand. I think that is a correct assumption.
Yes. Now, we have a problem, but do we have an option here? Yes, we do have. We have a company called Smart Buy Glasses, which could cater to India's aspirations for global eyewear brands. For instance, Smart Buy Glasses has 176 global brands, which on display, and it has more than 40,000 or 50,000 designs that the consumers could choose from. In addition, it has other significant attractive features that even the existing online retailers in India are not doing. For instance, they offer the lowest price guarantee, and they also have a 100-day return. In addition, they have their personalizations are phenomenally much better than what my Indian players are doing. But what is the problem? Why Smart Buy Glasses is not popular? Let's go to the next slide, please. So Smart Buy Glasses remain as a hidden jewel with less exposure and less traffic. When I researched on SimilarWeb, when Lenskart and Coolbeans are making 2.3 million visits, Smart Buy Glasses is generating only 45,000 visitors a month. And even if you look into it, the branded traffic is not at all there. It's just 94% for Smart Buy Glasses. And even the engagement metrics are poor. Even in our own consumer survey, 90% of the respondents, and these are respondents are who are B school, ex-B school guys who are part of big corporates. They are not aware of SBG at all. So this is problem one. Can we move to the next slide where we can discuss the other problems with SBG quickly? The other problem with SPG is that it does not support an Indian currency payment, and this means the customer has to pay an additional forex charges when they purchase. So it also means that it also lacks a popular payment options in India like debit cards, net banking. Nothing is there which is supported by SPG, which are offered by the other competition like Titan, Hyper, Lenskart, etc. And even they cannot support the bank-specific offers that that the other players are offering by partnership with other local Indian banks like ICICI or HDFC. These are the popular banks, but SPG could not partner with them because they don't have an Indian business, direct Indian business. Okay. The other problem, one of the biggest problems apart from this is the next one when it comes to the post-purchase experience. Can we move to the next slide, please? So the biggest problem that SPG has is that the end consumer has to own the responsibility of customs clearance and customs duties. This leads to a severe delay in orders with respect to more than 10 to 20 days on an average. This is even from my personal experience, I figured out this, and I also validated with the customer support there, that the consumer post-ordering has to share ID proofs, and other declaration forms to the logistics partner to get the customs clearance, and there will be also a bill from the logistics partner to pay the customs duty. The customer either pays himself or he can raise for a refund. He has to wait for a refund from SPG to get the money back. So these are the pain points that customer currently has while placing an order on SPG. So can we move to the next slide so we can discuss the solution? So Smart Buy Glasses need an Indian partner to localize itself to the Indian market. So it could not operate directly in India due to the FTA restrictions. So unfortunately, any foreign investors could not directly invest in a company, or a company that is foreign invested could not directly do direct retail on Indian market. So this prevents Smart Buy Glasses to accept local currencies and all the or even benefit from the bulk shipping discounts to India. They have to ship every order individually. to the customer, and that increases the shipping cost tremendously. So this is where my company that is in conceptual stages can help SBG. So SpecFash.com is a new Indian company that I am pioneering that could act as a dropshipping partner for smart bike classes to cater to the Indian market. So let's see what SpecFash could do. Can we move to the next slide, please? So SpecFash, because it could be a partner website for India, for India's operations for SBG, it could solve a lot of shortcomings that SBG currently faces. FTA restrictions. So SpecFash would be a 100% Indian-funded organization, so it can involve in direct retail. And with respect to brand reach and marketing, SpecFash would be investing in the digital marketing to increase its brand awareness, specifically on the Indian market. And local currency payments and local payment options will be supported because we will be partnering with the local payment gateways. And bank offers, of course, will be supported because we're going to partner we can partner with the local Indian banks. Customs clearance, bulk shipping, reverse logistics, all these will be simplified when we have an Indian holding or Indian partner who will be taking care of all these back-end processes so that the consumer just places the order and receives the order like a regular e-commerce.
Yeah. Rajesh, this is a concept that we've seen before a lot. We have case studies of people doing this in Russia, people doing this with Africa, and we actually have had a member here who was doing a very similar concept with an African company. So I'm very, very familiar with this concept, and I think it will work. There are some proven and understood ways of making something like this work, and I don't see any reason why the concept will not work.
Wow, that sounds assuring.
All right.
Yeah, sure. So can you go to? Yeah, just the positioning. So if I just want to position this particular company with my competitors, Lenskart and Titan are positioning themselves for the mass market and the middle market. I will position myself into the premium category as well as the mass market, as well as the middle market. Now coming to the questions, I got an assuring answer from you that this concept sounds fundable for even for Indian investors. Am I missing anything in this?
No, it is. Companies don't get funded at this stage, at a concept stage. Companies get funded after you build it out, start proving, start showing what your unit economics are, and so forth. So, you're nowhere near ready to be funded yet. What I'm missing, you're missing everything. There is no business here. It's just a few concepts.
Right.
And we don't make introductions unless you're part of the premium program. So that's not something we would do unless you're working within the program.
Okay. Sure. I will explore. Right. I will explore being part of the premium program too, Shama.
Okay. All right, folks. I will spend a few minutes explaining to you the program. I see Junaid's hand up. I know you've put in a question there. For a little while, let me answer your question. You say, I signed agreement with my current company that all the innovations, prototypes, patents I develop while working for them will be their property. I'm working as a software developer in an investment bank. Can I start a startup company while working for them? I think if it's unrelated to what they're doing, then yes, you can, but it's better to, to kind of check that out, depending on what you're trying to do. We see a lot of bootstrapping using paycheck case studies, and we have lots of members through the years who have done this process. So bootstrapping with a paycheck is something that we support. You can definitely join 1Mby1M and use the program to do your bootstrapping using a paycheck methodology, but we do recommend that you be clear with your employer that you're doing it and make sure that they don't have a problem with it, and you don't want to see a problem crop up later on in the process. Okay? All right. I will explain to you how to use 1Mby1M after this, and then we can go to further Q&A. I see other people trying to ask questions. So if you like what we're doing here, please recommend 1Mby1M to serious entrepreneurs. Building a business is a lot of work and it takes many years. So the word serious is therefore in bold. All our resources are at 1Mby1M.com. There is a terrific blog. There is the Entrepreneur Journeys book series that you can use to learn. There are 12 volumes of case study-based books. Bootstrapping with a Paycheck is one of the topics that we deal with in the Entrepreneur Journeys series. We have a lot of case studies. These roundtables happen every week. This is the 513th roundtable. Over 150,000 people have attended. The program is, the premium program is our full acceleration program. So if you're looking for introductions, if you're looking for, fundraising support, etc., ongoing consulting on a regular basis, all of that is within the premium program. And that also includes the curriculum, and we do have an extensive network. We work with hundreds of investors. If you are thinking about fundraising or even just validation, I would recommend strongly go to the self-assessment on our website. It's a free tool. These are the due diligence questions investors would ask you. If you get stuck, you can do 1M1M Basic, which is our curriculum-only $99 per month option. Go look at the website, dig around, look at what to expect from the premium program, from basic, FAQs, video FAQs, description of the curriculum. We have a case study-based curriculum. We teach the program in case studies and video lectures, and basically these curriculum and roundtables where we do the actual project-based coaching. Our methodology is lean, capital-efficient bootstrap startups. Our philosophy is bootstrap first, raise money later. No one can raise money without first bootstrapping a business to a degree of validation. All right, so that is all. Our next 4 free roundtables are going to be the 4 Thursdays of January. Please feel free to register if you'd like to pitch, and of course, if you'd like to attend. Online rendezvous are actually, these are the LinkedIn Live, Facebook Live, Twitter Live sessions that I do. We have one more left before we close off for the year, and then we'll start again on January 5th. We actually can take questions now. If you have more questions, you're very welcome to start asking. And if you have questions about the program, you should contact Irina Patterson. Her email is irina@1mby1m.com. She will answer questions about the 1M1M program. Let's see. All right, I don't see any other questions per se in the public chat. Does anybody else have any other questions? You can use the public chat or you can dial in. Either way is fine. Junaid, did I answer your question?
Can you hear me?
Yes.
Yes, thank you. Yeah, you answered my question, and thanks for answering. And, actually, the investment bank I'm working there as a consultant, and my vendor is a Indian consulting company. And
okay.
I have, which is actually travel related and event management related. So do you think
that has nothing to do with an investment bank? So I don't think there should be any problem with you starting something on the side.
Yeah, my consulting, the company I have, I'm actually working. That investment bank is their client, and they're actually a recruiting company, but they are totally unrelated, right?
I don't understand. So you're planning to start a company that on the side that is travel related, and you're asking if you can do that while working for an investment bank, and my answer to that is yes, I think so.
So no, actually, my company is a recruiting company, consulting company, and they're in the investment bank. So
you're consulting for the investment bank. You don't work for the investment bank.
Yes.
Then you can do whatever the hell you want to do. They don't own you.
No, that's not a problem. Like, my situation is that the company I'm working, it is like that, Tata Consulting Company or Wipro Company, like they're like a recruiting company. They hired and they placed me to their clients. So like I signed up agreement with my recruiting consulting company, and they are actually a recruiting company, and they put me in one of their clients, which is an investment bank. So I am doing, I am developing software for investment bank, but I am an employee of a consulting company.
Yeah. I think it's better that you check your employment agreements and you actually talk to the HR of the company that recruited you, whose employee you are, as well as the investment bank that you're working for. But I think if you're working in something completely unrelated on your own, that should not be a problem.
Okay, thank you.
You're very welcome. Anybody else, folks? Any other questions, comments?
Yeah, I have one question. You have monthly course curriculum and yearly consulting curriculum. Do you have that 1 hour consultation kind of thing that if
No. 1 hour consultation is a paid consultation that is available only to our premium members.
Okay.
So to access that, you're going to first need to be part of the premium program.
Sure. Thank you.
Yeah. Any other questions, folks? Joe, you're very welcome. It looks like we have answered everybody's questions. Well, this is the last roundtable for the year. We're going to recharge our batteries, and I'm sure it's been a very, very tough year for everybody psychologically, being so constrained and under this constant threat of not feeling safe. And that's just a, unprecedented state of mind that we've all lived in. Just to be safe is such a challenge. And I think it has weighed us all down to some extent. So, give yourselves lots of kindness and TLC and recover, get some energy back during the holidays. Hopefully you can spend some time with at least your immediate families. And I wish you all the best. Have a happy holiday season. Bye-bye.
Yeah. Thank you. Bye.